Hello and welcome back to Accounting 202. This is Chapter 24, Differential Analysis and Product Pricing. Okay, differential analysis. In managerial accounting, in management in a general sense, we need to make decisions based off of alternative courses of action. We call this differential analysis. It's making a decision between choice A and choice B. And oftentimes that type of decision will have a dramatic impact on the business in terms of cost, in terms of price, in terms of revenue. There's a lot of potential impacts on the business between making a decision between two choices. So, what are the steps that we need to take in making this types of decision? Step one is we identify the objective of the decision. Why are we making this decision? And what choice will maximize our income, right? That's the objective of business. We want to maximize profit. We want to maximize income. So step one, why am I making this decision? Which one will maximize my income? That's step one. Step two, identify your alternative courses of action. Do I go with choice A, choice B, or choice C? Okay, those are my three alternatives. Choice A, choice B, choice C. And it could be something like a product that you're purchasing to be able to sell. It can be something like a manufacturing decision. Am I going to manufacture this product, or this product? Am I going to make a decision to buy or lease an asset? Those are the types of decisions, right? And I look at various options. You remember some time ago we had an example of snowmobiles and riding lawnmowers. That was one of the companies that we identified in earlier chapters. That could be part of the decision. That could be, do I manufacture more snowmobiles or more riding lawnmowers? Things like that, right? So that's step two. Identify your alternative courses of action. Step three, gather all the information and perform a differential analysis. The differential analysis, again, is which one is going to maximize my income, possibly. So you look at those alternative courses, you want to look at each one and then analyze each one to figure out which one of those is going to maximize your income. That's step three. Step four is make a decision. Which one of those alternatives are you going to do? And step five, and we do this with every decision in management. We look at the decision we made, we review it, we analyze, and then we assess the results of that decision. Did we make the right decision? Do we need to go back and make another decision based off of that decision, using what we call incremental analysis? We'll talk about incremental analysis soon. Okay, here's an example. Let's assume we have a restaurant company, and this restaurant company is looking at replacing some of its tables with a salad bar. Okay, let's say it's Ruby Tuesday. Well, are they still in business? I don't think they are. They might be. Okay.
No, I don't think. I think there's like one left.
Okay, so let's use Ruby Tuesday as an example then, since there's one left. Okay, so we're Ruby Tuesday. Ruby Tuesday, as some of you may know, used to be a big salad company. They used to specialize in salads. So the company is looking at removing some of its tables and replacing it with a salad bar. Okay, so that's an interesting decision because here's the thing. You have seats, and then you got a salad bar. You take away some of those seats and you put a salad bar in. Now, here's the decision. The reason why this is a differential analysis is the seats themselves will earn you revenue by getting customers seated in those seats. Or the salad bar will earn you revenue through additional sales of the salad, right? That's where the decision comes in. So let's look at it. First, we identify the objective of the decision. The objective is to increase our income. We know this. Will more seats increase our income, or will a salad bar increase our income? Good question. Step 2. We identify the alternative courses of action. We use the existing floor space for the existing tables, or we replace some of those tables with a salad bar. Okay, those are my 2 courses of action. Step 3, we perform a differential analysis. Here we go. Alternative 1 is we keep our existing tables. Those existing tables that I would replace, they currently generate an average revenue of $100,000. They cost me $60,000, giving me an income of $40,000. Remember, revenue minus cost equals income. That's alternative 1. Alternative 2 is I replace those tables with a salad bar. The potential revenue from the salad bar is $120,000. The cost of operating that salad bar is $65,000. Give me an income, potential income of $55,000. Again, revenue minus cost equals income. So interesting so far. So that's step 3. We've gathered our data and we performed the differential analysis. The difference here is alternative 1 yields me an income of $40,000. That's just keeping the existing tables. Let's say it's like 3 tables, okay? Alternative 2 is we replace those 3 tables with a salad bar. The potential income would be $55,000 from the salad bar. So far, the salad bar looks like a good choice. So using that information that we just saw, we perform a differential analysis. A differential analysis is sometimes referred to as an incremental analysis. It's where we examine the 2 alternative courses of action. We look at the difference in the revenue, the difference in the cost, and the difference in the income. The differential revenue is the difference in the revenue between the 2 courses of action. The difference in cost is the difference between the 2 courses of action. And the difference in income is the difference between the 2 courses of action. Revenue minus cost equals income. So looking at the differential analysis, in those 3 columns where the positive amounts indicated the effect of the decrease, blah, 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 the first column is revenue, cost, and income. The second column is revenue, cost, of income for the second alternative. The third column is going to be the difference between the 2. So column 1 is alternative 1. Column 2, alternative 2. Column 3 is the difference. So revenue minus cost equals income, alternative 1. Revenue minus cost equals income, alternative 2. The difference. The difference here. You take your highest minus your second highest. Alternative 2 minus alternative 1. Alternative 2 minus alternative 1 is $20,000 for revenue. 120 minus 100 is 20,000. We take our cost, 65,000, minus our cost, 60,000. The difference here is 5,000. The difference between income, 55,000, minus 40,000 is 15,000. Or you could just simply say difference in revenue, 20,000, minus difference in cost, 5,000, equals a difference in income of 15,000. 20 minus 5 is 15. They both equal the same, right? So this shows us the difference between the two alternatives. That's differential analysis. Step 4 is to make a decision. Based off of the differential analysis, we identified that by putting in the salad bar, we could potentially increase our income by 15,000. So that's step 4, make a decision. So it looks like our decision is go with the salad bar. It's going to yield us an additional 15,000. Because remember, based off of step 1 is how can I maximize my income, right? So because of that, the clear choice here is alternative 2, which is install the salad bar. Step 5 is review and analyze and assess the results of my decision. So over time, the company should look at that decision and identify whether it was the right decision or not. So year 1, did it make me an additional 15,000? Year 2, did that change? Did my cost change? Did my revenue change? Year 3, I compare it to year 2. I compare it to year 1. If we realize that our revenue is still going up year to year, then we made the right choice. We don't need to make any corrections. However, if I realize that year 1, it was 15,000, year 2, it's 10, did I make the right choice? I don't know. I might need to make some corrections. That's why step 5 is assess the results of the decision. So, a couple of common things that we use differential analysis for. The good old lease or sell equipment. If I lease equipment, I can make money off of the lease. If I sell it, I can make money off of the sale of the equipment. That's a differential analysis. Discounting an unprofitable segment, or I'm sorry, discontinuing an unprofitable segment. For example, if I sell snow blowers and lawnmowers, the snow blowers do real well in the winter time, the lawnmowers do real well in the summertime. I have 2 models of lawnmowers, one not selling so much, I might discontinue it because it's not profitable. But I would do a differential analysis to figure out if that's the right decision. Manufacturing or purchasing a needed part. Making or replacing, as we say. Selling a product or processing it further. Accepting an additional business at a special price. Again, these are things that we would run differential analysis for to determine which one is better. In the lease or sell decision, management may lease or sell a piece of equipment that we no longer need. This occurs when a company changes manufacturing process, no longer needs the equipment to do that process. Using this decision, we would do differential analysis to make that decision. So here's an example. Let's assume that our company is considering leasing or disposing of a piece of equipment. The cost of the equipment is $200,000. The accumulated depreciation is $120,000, giving it a current book value of $80,000. Again, cost of the equipment minus depreciation equals book value. You guys learned that from earlier chapters, right? One alternative is to lease it. Another alternative is to sell it. If I lease it to another company for 5 years, I can generate revenue of $160,000 for those 5 years. The estimated cost of repairing, insuring, and for taxes of that leased equipment is $35,000, which would give me revenue minus expense would give me about $125,000 of potential net income from alternative 1. Alternative 2 is if I sell it. If I sell it, I can sell it for $100,000. But then I have to pay a commission on the sale of 6%. So let's look at the two alternatives through differential analysis. Revenue from the lease, $160,000 minus cost of the lease, $35,000, $125,000 potential income. If I sell it, I can sell it for $100,000, but I have commission I got to pay of $6,000, 6%, right? Gives me a total income of $94,000. I do a differential. The difference here is $60,000. Alternative 2 minus alternative 1 is $60,000 minus $60,000. The cost is $29,000 difference. That's $6,000 minus $35,000 is $29,000. Two minuses, right? Then we have your difference in income, $31,000. 94 minus 125 is 31, minus 31. So we can see that the best decision here is alternative 1, to lease it, because, again, going back to step 1, the objective is which one's going to yield me a higher net income. In this case, alternative 1 is going to be higher. So that's lease or sell. The only differential revenue here is included in the differential analysis. So looking at the book value, $200,000 minus $120,000 in potential revenue, book value is $80,000. We have what we call sunk costs. Sunk costs are costs that can be incurred in the past, that have been incurred in the past, cannot be recouped or relevant to future decisions. If I lease a piece of or sell a piece of equipment that I own, I cannot continue to capture the cost of depreciation. So therefore, the depreciation or the book value cannot be captured. That $80,000 will not affect my decision. The $80,000 book value will not affect my decision because I'm either going to lease the equipment or sell the equipment. So therefore, the book value, we call that a sunk cost. What about the decision to discontinue a segment or a product? Sometimes we make decisions to eliminate a segment or a product because it is no longer profitable, or it's what we call obsolete. Obsolete. It's been replaced by a newer product, or whatever. In that case, we make a decision to discontinue a segment or product. But the only difference here is that even if I just discontinue a product, I still have to account for fixed costs such as depreciation, insurance, and property taxes. So those things will not be considered in the decision. So let's look at Post Cereal. The Post Cereal company produces Corn Flakes, Toasted Oats, Bran Flakes as products. We have sales, cost of goods sold, fixed costs, operating expenses, things like that. So we got product 1, 2, 3. Which total of $1 million in total company sales, blah, 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 blah. So we got our 3 products and our total company. If we are looking to discontinue our Bran Flakes or continue it, we look at a differential analysis. We take the revenue and the costs associated with that product. Revenue, $100,000. Variable cost, $85,000. Fixed cost, $26,000. Gives us a minus or a loss of $11,000 for that product. If I decide to stop making that product, which is alternative 2, I'll have zero revenue. I won't have any variable costs, but I'll still have my fixed costs. Again, my fixed cost is like my my overhead. I'm still gonna have my overhead, but I won't have my direct materials or direct labor. But I'm not gonna have any revenue either because I'm no longer selling it. So if I discontinue it, it's minus 26. So then I do my differential analysis. Minus 100,000 for revenue. 0 minus 100,000. 85,000 for variable costs. 0 minus 85. 0 for fixed, because it's the same, right? Gets me a loss of 15,000. So looking at this decision, I would make the decision to continue making the bran flakes. The reason being is because I would lose less. I would lose less if I were to continue it than I would if I were to discontinue it. What about the make or buy decision? Companies that manufacture have to make a decision to either make or buy parts, products. Example would be an automobile manufacturer. They make cars, right? A car manufacturer has to make or buy parts for the cars. Okay, so they would use a differential analysis to make that decision. So let's assume the company is currently purchasing instrument panel for a car at $240 per unit. The company is currently operates at 80% capacity. And there are no major increases in production. The cost per unit of manufacturing is shown below. We have direct materials of $80, direct labor $80, variable factory overhead 52, fixed factory overhead 68, giving us a total cost per unit of 280. So if I make it in-house, I would make it for a total of $280. It'll cost me $280. If I buy it, it'll cost me $308. Why $308? You still purchase it. You still have fixed factory overhead regardless of whether you purchase it or if you make it. So $308. The difference here, difference in purchasing is $240. Direct materials $80. Direct labor $80. Your variable factory overhead $52. The difference is $28. Okay. So in this case, my decision would be to make it because it will cost me less to make it than it would to buy it. What about replacing equipment? We can use differential analysis in the decision to replace equipment. Equipment over time becomes worn out, no longer usable, it just no longer works, whatever. Things happen, right? So let's make a decision to replace our equipment. So let's assume the following. Our old machine that we want to replace has a current book value of $100,000. Its estimated annual variable cost is $225,000. I can sell it for about $25,000. It has a remaining useful life of 5 years. Okay, that's our old machine. If I replace that old machine with a new one, the purchase price of the new machine is $250,000. Variable cost $150,000. There's no residual value. Estimated useful life 5 years. So let's do a differential analysis. My current machine, zero revenue. Purchase price, I already have it. I don't need to purchase it again. My current variable manufacturing cost for 5 years is $1,125,000. How we got that? You're probably asking. You take your annual variable cost times the 5 years. To replace the machine, I would sell the old one for $25,000. The new one cost me $250,000. The variable cost for the 5 years is $750,000. How is $750,000? You take your $150,000 times 5 years. Gets you to a net loss of $975,000. You do your differential analysis, $25,000 coming in from selling the old machine, minus $250,000 for the purchase of a new machine. The difference between the two variables is $375,000. Gets us to a net income of $150,000. So the clear decision here is to replace the old machine with a new one. And how do we come up with that decision? Because our net loss is less with the replacement. We call these opportunity costs. Revenue that is foregone from alternative asset is called an opportunity cost. Although opportunity costs are not recorded in accounting, it's useful to understand the alternative courses of action. What about the decision to process or sell a product? During the manufacturing process, we go through various stages in the process. Sometimes we would process it further and then sell it, or just sell it. This happens like when I make improvements to products, right? So here's an example. We have a company that sells kerosene. There are derivatives of kerosene. One will be gasoline. If I further process oil from kerosene, I can make gasoline. Oil is the primary product. You can process it to make kerosene, then you can process it even further to make gasoline. Currently, the company makes kerosene. Batch size is 4,000 gallons. Cost producing the kerosene is $2,400 per batch. The selling price is $2.50 a gallon. We can further process it to make gasoline. 4,000 gallons minus evaporation of 80 gallons is 3,200 gallons. The cost of producing each batch is $3,500. Selling price is $3.50 a gallon. So let's look at the differential analysis. Revenue for kerosene, $10,000 minus cost, $2,400 equals $7,600. For gasoline, $11,200 revenue minus $3,050 for cost equals $8,150. The differential analysis, difference in revenue is $1,200. You take your alternative 2 minus alternative 1, $1,200. Difference in cost, minus $650 because it costs $650 more to process gasoline. The difference in income is $550. The clear choice here is to continue processing and make gasoline because, according to step 1, I would generate additional revenue, additional income. What about the decision to accept it at a special price? You could do different. This means basically I negotiated a price for sales, right? Let's assume this company makes basketballs. They produce 12,500 basketballs in a month. Current monthly sales is 10,000 basketballs. Normal domestic selling price is $30. It costs me $20 to make a basketball. $12.50 per basketball variable cost plus $7.50 fixed cost. I can make these overseas at $18 each. So what do we do? Or overseas wants to buy these at $18 each. What do I do? Alternative 2, 90,000 minus variable cost 62,500 equals 22,500. It's a clear choice here, alternative 2. Selling normal product selling prices if we change prices, we could look at this from a perspective of setting prices. Okay, let's talk about prices. Setting normal prices for product. Typically what we do is we look at, is the selling price going to cover my fixed and variable costs? It has to, right? That's the idea. Otherwise we're selling it at a loss. When I set prices based off of demand and competition. Demand tells us how much people are willing to buy at a particular price during a particular time. Competition, who else is selling the same products that I am? I look at those two things to determine my selling price. We can also use one of three cost plus methods: product cost method, total cost method, variable cost method. A product cost plus method. When I sell a product, I take my cost per unit plus markup. Markup is the amount of profit I want to make on each product that I sell. So cost per unit plus markup equals my normal selling price using the cost plus method. Using the product cost method, I look at the manufacturing of the product, determine the product cost, and I include the cost amount per unit to which the markup is added. I estimate my selling expenses, which include selling administrative and any type of commissions, and the desired profit. We include those things in the markup. Markup per unit is then computed and added to the product to normal selling price. So when you go to Macy's and you buy that fancy shirt that you always wanted, you better believe that there's a lot of markup in there. Okay. Markup includes selling administrative expenses, selling expenses, and the desired profit, plus the cost of making the product.
Oh, okay, so now I know why they want the $100 for this Kirk Geiger. So that pocketbook is not worth it. It's because of the way it's designed, it makes you think it's worth $100 because it's got this fancy little emblem. But I really want it because it go with a pair of my shoes. But now I think you say out of all of the material and everything they put.
Yeah. Exactly right. So the cost of the cost of the product is direct labor, direct material, factory overhead. Then the company Macy's goes, okay, well I got it produced. Now let's figure out what my overhead is. How much is my administrative expenses? Those are the salaries of the store managers. That's the all that other nonsense. Then you got your selling expenses. That's the commissions I got to pay to my salespeople. Okay, then how much profit do I want to make? Well, for clothing, it's like 600%, right? So you go 600% of whatever your product cost is plus this. That's why when they put something on sale at 90% off, you better believe they're still making a profit.
You right about that. You ain't never lied. Because I was like, why this bag cost this? It should have been like $59.99 maybe.
Exactly right. That's how it works. So the product cost method is applied using these following steps. Step 1, I estimate the total product cost as follows. Direct materials, direct labor, factory overhead equals total product cost. Direct materials plus direct labor plus factory overhead equals total product cost. Step 2, I estimate my total selling administrative expenses. Step 3, I divide the total product cost by the number of units I expect to be produced and sold during the period. So total product cost divided by total number of units I expect to produce and sell. Step 4, compute the markup percentage markup percentage, desired profit plus selling administrative expenses divided by total product cost gives me a markup percentage. The desired profit is normally computed by the rate of return on the asset. Desired rate of return times total asset equals desired profit. Step 5, determine the markup per unit by multiplying the markup percentage that we got from step 4 times the product cost per unit that we got from step 3 or 2. Markup percentage times cost per unit equals markup per unit. Then step 6, final step here, we take the product cost per unit plus the markup per unit equal the normal selling price per unit. So in this example, we have a product, I don't know what this is, calculators. We sell calculators. We're going to sell 100,000 of them. Okay, 100,000 calculators. Direct materials, $3. Direct labor, $10. Times 100,000, that's 300,000, that's $1 million. Factory overhead, 200,000. Total manufacturing cost for making 100,000 calculators is 1.5 million. My selling administrative expenses is 170,000. You take your total manufacturing cost plus your selling administrative expenses equals your total cost, 1.670. Our total assets that the company has is 800,000. Our desired rate of return is 20%. So we take all of this information and we figure out what is going to be our product cost, or what's going to be our selling price, okay? So, step 1, product cost, 1.5 million. That's your direct materials, direct labor, factory overhead. Step 2, selling administrative expenses, 170,000. Step 3, total cost per unit is $15 per unit. How we got there? You took your total product cost, 1.5 million, divided by the 100,000 units we produced and we're going to sell. That's $15 per unit. Step 4.
Not to stop you. That's where I got. I started that on the homework, and I kept coming up with 400,000, 300,000, 100,000,
Got
500,000.
Yes, so you probably had these two reversed is my guess. So you want to take your total product cost divided by the units produced and sold. So 1.5 million divided by 100,000 units, $15 per unit. Step 4, the markup percentage. So to get your markup percentage, first you figure out your desired profit. Desired rate of return times total assets. Desired rate of return is 20% times total assets, 800,000. That's 160,000. Okay, got that. Then I figure out my markup percentage. That's desired profit, which is 160,000, plus selling administrative expenses, 170,000, divided by total product cost, 1.5 million. It gets us to 22%. Or 0.22. Then you multiply that by 100, gets you 22%. Okay, then we figure out what is our markup per unit. Markup percentage, 22%, times cost per unit, $15, equals $3.30 per unit markup, which tells us that our normal selling price should be $18.50 per calculator. How we got there? Total cost per unit, $15. Markup per unit, $3.30. Those two added together is $18.30 per calculator. Okay, target costing. This is a method by where we look at market-based pricing and cost reduction emphasis. By using target costing, we anticipate what will happen with demand or competition based in markets to figure out our target cost, we take our expected selling price minus our desired profit, gets us to our target cost. This is just looking at it's basically the difference between present and future, looking at current market prices and expected market prices. Target cost is usually less than the current cost. It's a way for us to drive costs down by reducing labor, reducing the cost of materials, simplifying the design, eliminating waste. Those are ways where you reduce cost. What about production? In production, we have these things that happen. We call them production bottlenecks. These are constraints. These happen in the manufacturing process where the product exceeds the ability to produce the product. My demand is too high. I don't have enough capacity in my factory to produce enough. That's a bottleneck. Okay. The theory of constraints, manufacturing strategy that focuses on reducing the influence of bottlenecks in the production process. When a company has a production bottleneck, it should attempt to maximize profits by reducing costs and increasing its revenue. In this example, this company sells 3 different types of products: product A, B, and C. Selling price per product, $130, $140, $160. Variable cost per unit, $40 for each one. Total contribution margin, $90, $100, $120. Remember, contribution margin, selling price minus variable cost equals contribution margin. The cost or the total number of hours it takes to produce each unit, 1 hour, 4 hours, 8 hours. And we learned about this before. Unit contribution margin, but this is per production bottleneck hour. We take the unit contribution margin divided by the number of hours within the bottleneck. So unit contribution margin divided by the bottleneck hour. Product A, it's $90. Product B, it's $25. Product C, it's $15. And that is the end of chapter 24. Are there any comments, questions, concerns, chapter 24?
I'm just glad that you went through it, because now I see where I was making a mistake on the homework. But I'm glad that we're able to sit there and get it correct and do it, do it right. So I'm happy that I stayed the whole class. So
I'm glad you did too.
Go over it. So I noticed where I had went wrong, so I had fixed it. So
Perfect.
I'm glad I stayed.
I'm glad you did too. Wonderful. Samaya, are you okay? Are we good? Sorry, she probably stepped away.
I'm sorry.
Oh, you good? Are you good, Samaya?
Yeah, I'm okay.
Okay, cool. Wonderful. Awesome. Okay, so if neither of you have any questions, comments, or concerns, yeah.
So can I do the final? When can I do the final exam?
It's technically it's open right now if you really wanted to take it.
Okay. So
But-
I wanted to study. So I basically wanted to have it done by Sunday.
Yeah,
So I
but
wanted to have it done before Sunday.
I can go back downstairs.
we do
Say it
have
again, Professor?
we do have 2 more chapters to go through next Tuesday. So you might want to wait until we go through those before taking the final, but it's up to you.
So is your final scheduled?
Yeah, so it's scheduled for the last day of the course.
Okay.
Okay, cool. And then that might change a little bit depending on because I should be getting a list of I should be getting a list of graduating seniors, I think. So as soon as I get that list, I'll let you know. But right now, it's scheduled for the last day of the course.
Okay.
Okay, so wonderful. So if there's no other comments, questions, or concerns, I'd love to call this a day.
All right. Thank you, Professor.
Thank you so much. Have a wonderful, wonderful day. And I'll see you again next Tuesday.
Yes, sir.
Okay. Take care.